Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be discussing how to begin investing in the stock market. Now, this will be a very basic video, and it may or may not cover every single thing to do at the very beginning of investing, but I feel that these are some things you need to have in mind. You need to, so we're going to be talking about what to do in the short term. We're going to be talking about emotional attachment to money and how having more of it can affect you. We'll talk about how to decide on your platform of trading, and then developing your strategy, or kind of giving you ideas on what kind of a strategy you may want to be or become and use during your investing in the future. So of course, if you are new to my channel, I make stock market and investment videos daily, so consider subscribing. Thanks. So, very first slide, what do we have to do? And of course, this presentation is only 5 slides, so it's very quick. So, what do we have to do in the short term to begin investing? We need to get over some short-term pains. We need to go out there and get a job. If you're 16 years old, if you're 18 years old and you haven't had a job, you've been going to school, going to college, you need to go out there and get a job, because what do you need in order to begin investing? You need cash left over from your expenses. So you need to get out there and get a job. If you are not quite making ends meet in your month to month, you're starting to become debt is starting to build on month to month, you need to get out there and get a second job. These are short-term pains. You need to be doing this when you're young, because when you're older, you don't want to be having to work 2 jobs in order to provide for your family and yourself. You need to do everything you can while you're young and mobile and have the strength. And of course, if you don't want to get a second job, if you don't want to go out there and get a job, you can create your own job. Some fields that are pretty easy to get into technically would be cleaning, door-to-door cleaning, house cleaner. So you go out there and purchase your own supplies for $500 or less, and you can start with friends and family and clean houses for 2 to 3 houses. Just wipe everything down, dust everything, vacuum, and you have all your equipment. You could easily get everything you need for $500. You do carpets and everything, and you could easily get word of mouth and then begin going door to door with your endorsements and such from your friends and family with how well of a job you've done. And that could be a job where you can do yard maintenance. A lot of elderly couples that both work, male and female couples, or just married people that are married that have dual responsibilities and they both go to work. They don't have a lot of time during the day and weekends to spend in their yard pulling weeds and mowing the grass and keeping doing a lot of the yard maintenance. So you can come by, have pictures of your past work, same thing, word of mouth. You start with friends or family and build yourself up and get a portfolio or a email list and job list of everyone and get that all scheduled. So you can go out there and become an entrepreneur. So once you've got your job, once you've got your second job or you created your job, you need to start working on a budget, because having your budget on paper in front of you makes it so much easier to keep on track. Dave Ramsey has a great example of this. If you've never watched or heard of Dave Ramsey, he has a great budget system where, depending on what your net income is, you have separate envelopes that you stash money into. If you get paid $1,000, you put away 10% for entertainment. So 10% of $1,000 is $100 you would put towards your entertainment for the month, and you would not go over in any that you had left over. Could be applied to the next month, but you would never spend more than your allotted percentage for that specific month. So of course you have your food, your mortgage, so you always cover your basics, your housing, food, and shelter, food, and water. Those are your basic needs, so you always need those in your expenses. And then you can start adding in such as clothing and utilities, and there's just a huge amount of different expenses that come out of your net income. So set up your budget that takes your net income after taxes minus your expenses. So again, we talked about that: mortgage bills, utilities, phone bills, etc. Think when you're out and shopping if it's a want or a need. Do you need to buy that cookies? Every time I go through the store and I'm buying everything that I need for the week, milk, salads, my chicken for my lunches that I take to work, my oatmeal that I have for breakfast, or my shakes and such, fruit for shakes. Those are all needs that I need in order to save money instead of going out and buying something during lunch. Now, if I see some cookies on the side and I haven't ate a cookie in 2 months, is that really a want or a need? Of course, it's going to be a need because I don't need that cookie. That's an extra $6 that could become $12 or $30 with time invested. So that's the way I think, especially when it comes to Starbucks and everyone going out there and spending money on coffee. People dump so much money in coffee, $40 to $50 at least a week. Some of these people that I've seen. So always number one thing is pay off your debt. If you have a credit card and you carry over your debt month to month, within a year, most credit cards have a 16% interest rate. So if you have $1,000 in debt, within the year you'll go $160 in debt, even more, and that just continues to build. So interest can work against you the same way it can work for you. So you need to kill off your credit cards, or not kill it off. You need to pay it off, and it will kill anything that you make while you're investing. So it is imperative that you pay off your debt, and your credit card is the most important thing. A lot of other debt, such as student loans or mortgages, they usually are really low, 0 to 4%. I know a lot of friends and family that have mortgages in the 3%, which is, that's not bad. That's not a, hey, pay off right away. You could have $120,000 to pay off your home, or you could have $120 to invest. If you pay off your home, yes, you'll save 3% in the long term in 30 years, but if you use it to invest right away, you can get an average of 7 to 8% return in the S&P 500, along with dividend payback of 2% with an average of around 9% per year, which could easily pay off your mortgage and have a little bit of money on the side in the long term. So once you've created your budget, you have your net income, you minus your expenses from it, and you've set something to pay off your debt, you then need to build up a 3 to 6 month reserve using your budget. This will be your rainy day fund and in your emergency fund only. So keep the remaining on your savings. Once you build up 3 to 6 month reserve and you have your budget from month to month, you just multiply that by 3 months. If your monthly expenses is $2,500, that is $7,500 in 3 months, or $15,000 in 6 months. So have between $7,500 and $15,000 in reserve and a savings account, at least at 0.15% or higher, and that's pretty easy to have. That way you have easy access to it for emergencies only. Okay, then you want to begin investing in yourself. So of course, for your emergencies only, you want to have this money on the side, because this is money. Once you begin investing, you don't want to be pulling your money out of the investments in order to pay off your car, your mortgage. You have accidents, you get laid off from work, or you get fired, or you have a vacation and time away. You don't want to be pulling your money out of your investments. You want to have this emergency money on the side that you can use. And once you've done that, then you want to begin investing in yourself, at least 15% of your budget towards investing. And of course, that can start lower. If you want to invest with 5%, 10%, 15%, just whatever you can, put that into your budget. Start off with 5%, and if you can increase that to a maximum of 15% per month, go ahead and do that. That should be one of your goals, of at least investing 15% at the beginning of your net expenses. That should be marked as sort of like an expense, like a mandatory thing to do, because investing in yourself for your future is one of the most important things you can do. So emotional attachment, and this goes along with stocks and just life in general, and you will lose money all the time. So say it out loud and say it over. Be like the 10%, yes. So a statistic online says that over 90% of investors lose money. You want to be like the 10%. Don't be like the 90% that invest in something because they heard it online, they read about it, there was popular news about it. That's how you lose money, because once you buy into the hype that something is on fire and you purchase it, that can only trend up for you. It's already been public, so the trending up has already pretty much passed. All it can do from that point is fail. So you want to be on the lookout for dips instead of reading it on the news and investing in it. So don't let your money control you with greed. Raises can mean that you can buy more in your head. So a lot of people out there will say, when they get a raise, say if you have a salary of $50,000 and you had a raise of $5,000, so now you're making $55,000 a year. You know, you get that greed that goes to your head, and it begins to affect you in wanting to have bigger and more things. So now you see a car, you know, you got to raise the $5,000. I've really been wanting to go out there and purchase this new Nissan Altima for $30,000, and it has the sunroof and everything in it with the Bluetooth and the adjustable seats, and I can go out there and buy it now because I got to raise a $5,000. Well, that $30,000 is going to run you 6 years of at least what, $500 a month to pay it off over the 6 years. So that's not a good trade-off. So don't fall into greed. When I was when I was reading Rich Dad Poor Dad, and Robert had been offered $1, $2, $5 for working at the store per hour instead of his original 10 cents. He was beginning to think into all the new things that he could purchase with that, you know, that additional money. Being a 10-year-old in a school with $5 income was more than most adults were earning at that time, and he could be the richest kid in school. But once it got to a proportion where it became too much, he began to overcome that feeling of greed. So think of ways that you can retain your wealth and build it. So again, back to the want or need. This is something I constantly ask myself, whether it is a want or a need. And then of course you will lose money while investing. The trick is to make sound choices and not lose it every day. And of course there are days in the market where I've lost multiple days in a row, just down, 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 and then I've had an upside, and that's completely normal. The market's not always going to move in a positive direction. No matter what stock you invest in, it is never ever going to be every single day positive. There will be times where you will lose money, and then there will be times where you will make money. The trick is to, of course, make it at least 75% of the time, whereas you're losing only 25% of the time. And that takes time to study the stock, look at its finance, and just that's all stuff that we're going to cover in the future. So just going over a stock and diagnosing it and giving it a good analysis of whether it's a purchase or ignore. So once you've overcome your first things, you've got your budget down, you've started investing in yourself, you saved 3 to 6 months of emergency funds, now you're ready to take that money that you are setting aside for investing and decide on your trading platform. Now, I am currently using Robinhood, and I believe this is an absolute one of the greatest platforms out there for brand new investors. If you have $50, we'll say $100. If you have $100 to invest, and we look at the fees, I thought I fixed this in my slide, but I messed up. If you have fees out there, so Thinkorswim and Merrill Edge are other great platforms, and I'm going to be making a video on Merrill Edge, so I'm just going to cover these really quickly. So Robinhood is fee-free, meaning that you can trade, you can buy and sell stocks for completely free on the Robinhood application. And one of the downsides is that they don't offer drip, they don't offer any IRAs like retirement funds, but if you're just wanting to get invested in the stock market, it's a great app because this will save you lots of money in the short term. And as a brand new investor, if you're starting off with $100 and you're buying and you're paying a fee of $6.95, that is 6.95% that you lost buying your very first stock. That means in order to make money from that sell, you need to recover your 6.95%, plus when you sell is another $6.95 fee. So that means total you're basically looking at a 14% loss with a buy and sell. So in order to make a profit on these other platforms, you must have a recovery of at least 14%. Now this changes as you add additional funds. If you have $1,000, it becomes much less. Now it's 0.695%, and if you have a $10,000, now it's it's 0.006%. So if you're brand new to investing and you're only starting off with a little bit, $100, Robinhood's a very great, very good platform. And also they do have a referral program. If you go through my referral link that's in the description below and you use the web interface, use your web browser to sign up, because my buddy did this today and he signed up and he got a free share of Serum XM and I got a free share of Sirius XM. But my other two friends and my wife that signed up for Robinhood, they went through the app. Neither of us got credit for it, so they didn't get a stock and I didn't get a stock. So that's something to keep in mind. So Thinkorswim is another great platform. They do have a fee of $6.95, but if you're brand new to investing, they do offer paper trading. So if you're not quite ready to begin investing and you're still working on your budget and beginning to invest in yourself, you might start off by using paper trading, and I believe they offer some amounts of thousands of paper trading, so you can just have that begin trading and getting your feet wet in the system. Thinkorswim is another great one. It does have really great charts. That's something that Robinhood doesn't have. Robinhood's graphs are completely wrong, and I really like it just for the fee free, but I do everything else outside of Robinhood. Thinkorswim, on the other hand, has really good graphs, candlestick graphs, and has a good information. Merrill Edge is Bank of America, Merrill Edge. It also has a $6.95 fee, and it currently has a bonus where it's fee free if you have $25,000, I believe, in their Bank of America account, or $50,000 in your investment account. I have a Merrill Edge video coming up here shortly, so that'll all be covered within that video. And then of course, these are really popular brokers, but there's many more out there, and I have a video coming up with different brokers as well. So this is very basic. Learn about different types of investments. So learn about your stocks, your bonds, your REITs, your ETFs. So stocks, most common trade are the common stocks, followed behind by I bonds and EE bonds, and then you have your REITs, which is your real estate investment platforms, and your ETFs, which are kind of bundled stocks. Another term that I've heard of is motives. So learn about your different types of investments, and you can pick up some investment books. I have some good ones in the description below. Let's see here. Once you've chosen your platform that you're going to begin doing your investments on, you need to develop your strategy. Are you going to be a growth investor, a value investor, actually I talk about growth versus dividend versus penny stocks. Now, you make the most money in penny stocks, but it's also it's the riskiest. That 90% that lose money in the stock market, that is because they went for penny stocks. Now, I do not advise doing penny stocks as a beginning investor. As a beginning investor, you may want to look at either ETFs or dividend stocks, just because there is much less of an up and down, and that could trigger your fear and make you sell, but you never want to sell on a loss. So depending, if you're brand new to investing, you may want to look at dividend stocks or growth stocks. And growth stocks are just stocks that are similar to Amazon and Google, that are not paying out a dividend. They're not paying out portions of their earnings to consumers and stockholders. They instead reinvest all of their earnings and their revenue back into their company in order to grow it much larger, such as Amazon is doing. Then you have your day traders, your swing traders, and your long-term traders. Day traders, of course, they trade by the day. Swing traders can hold stocks between 2 to 3 days to a couple weeks before selling it and trading it off. And then long-term traders is what I'm currently doing, which I buy a stock and I'm trying to hold it for the long term. I look at it to analyze it, whether it's going to be increasing its dividends in the future and how much it increases its dividend, what's its dividend growth, and there's a lot of other measurements that I like to look at when I'm looking at a stock, a dividend stock for the long term. And then you need to understand your order types. Now inside Robinhood, these are for the very basic ones. Your market buy, which buys at the market level, and when you're making a market buy, you know what, we'll cover this in another video. So these are very basic ones. So you have your market buy, your market sell, your limit buy, and your limit sell. Basically, your market buy and sell at whatever the current market price is. Your limit buy and sell is you put a specific amount of what it will either buy at or it will sell at, and it cannot be anything other than what you put your limit and buy and sell at. Develop rules for yourself and start off slowly. Stick to your rules. write them down and stick to them. And if you have any mistakes, you can scratch it out and write down what you learned from your mistake, and that is the best way to learn. So once you've done that and you've chosen your platform, you've came up with your trading strategy, begin monitoring stocks and apply your trading strategies to these stocks, and apply your strategy and stocks. Of course, you want to buy on discounts, so dips. When there's a dip, that's considered a discount. So Nvidia the other day went down 8%. That would be a awesome time to buy on that dip, because it's such a great brand and company that, you know, Monday morning when the market opened, it went up an additional 10%. So anyone that was out there and they saw that Nvidia had gone down 8% and bought in, easily recovered the 8% plus gained an additional 2%. So you always want to buy on dips and you never want to sell so on those dips. So you will see gains and losses, and it's completely okay and normal. So that is it as far as going over the basics of how to get into investing. My name has been Brent, and of course, if you're brand new to my channel, I make stock market and finance and investment videos daily, so do consider subscribing. If you did like the video, hit the thumbs up button below, helps out my channel. And if you have any questions or just want to say hello, please leave a comment and I will always reply. This slide will eventually be on my website once I upload it on there, and then I'll have a link in the description below to that. So that is it. Thanks for tuning in, and I will see you next time. Bye.